Markets have been on the move. Volatility, shifting Fed expectations, and big moves in fixed income. As we wrap up the first quarter, what drove performance and how should investors position for what's coming next? We're going to break it all down for you right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thanks so much for sitting with us today. Leslie Falconio is back in the studio with me. Leslie, I'm going to put you to the task today because there's so much happening in the world of the markets, but drilling it into fixed income. How's the first 3 months been for you? Because, boy, what a head spinner it's been. Crazy volatility, lots of uncertainty. What have you seen?
You know, what you just said is so true. When you think about the first 3 months of the year, first of all, let's talk about really quickly how we entered 2026, right? Slower but stable growth, strong consumer, household balance sheets were strong, wage growth was, stable to slightly higher, and you had January performance where you really started to break all these records, right? Spreads were tighter, gold was up. It was really one of those Goldilocks on steroids kind of environment. You go to February, right? The sentiment completely shifts. We have AI disruption, potentially leading to job losses. You have private credit concerns. And then all of a sudden we focus on the slower growth outlook, which took the market to say, okay, 10s go down to 395. We have 3 cuts that they thought priced in for the year in 2026 at the end of February to shift again, once again in the first, in March as we focus on the conflict in the Middle East. Then the concern over growth takes the back seat. Everyone focuses on inflation, and whether or not that's going, what the duration of the crisis is going to be, whether or not it's going to impact the household purchasing power in the long term. So inflation became the component. Those cuts are removed, and interest rates move higher. So it's really been, when you think about just 3 months, you've had several different mini cycles in a 3-month time period.
Yeah. It's, well, the big question, and I think, you sitting as a fixed income professional here, you have to wonder what the Fed is thinking, right? And I know that right now the CIO, our Chief Investment Officer here, we think that the Fed is going to still cut twice this year. Towards the back of the year, though, this time, we're kind of pushing it down the road a little bit. 50 basis points in total between the two is what the thought process is here?
Correct.
So the question then is, with potential spikes of inflation, now it could be short term. We don't know how much longer the conflict is going to last, but certainly inflation is going to go up this month. The Fed then has to make a decision about what they're going to do as we see job growth slowing down a little bit. What does the Fed need to do here?
Right now, nothing.
Right.
And I'll tell you the reason why.
That's the best answer you could have said.
Right, because look, so we have CPI coming up, and we know there's going to be inflation numbers that we're going to see that will most likely be on an uptrend. We know that we were still feeling a bit of headwinds, if you will, because we had core goods inflation that was still trending above what the Fed's target would like to see. But again, when we look at the curve and we look at what's happening right now, okay, most of these inflation expectations, as you pointed out, they're actually in the short end, right? The longer term inflation expectation, and what the Fed really monitors, right, that 10-year, you haven't seen a large spike. So what this is saying is the market's saying, yes, inflation's going to go higher as we have, obviously oil prices up and, for longer than what people originally anticipated. And not only that, that floor that we once saw in oil is going to be higher even after a resolution, comes to mind. But still, you don't have that back end really saying there's going to be a lot of inflation. What that means is that more than likely this would be, a temporary, if you will, hit, a temporary headwind. And so therefore, the Fed is, the best thing to do for them is to stay pat right now, particularly given the unemployment report that we just saw on Friday, right? I mean, 4.3 unemployment rate, around 173K, in terms of jobs. That was something that was, an unexpected surprise. And I just think really solidifies the fact that the Fed's going to be on hold for a while.
Yeah, that's great you said. Because even Powell himself recently, when questioned, he said we're in a wait and see approach right now. And obviously he agrees with you. So he should call you and ask what you think. So thank you, Leslie. I appreciate that. But let's step back a little bit, because when you look at yields, when you look at spreads, when you look at flows, How have the fixed income markets been reacting to the volatility that we've seen, and specifically the uncertainty that's out there right now for investors?
Yeah, listen, we are all subject to, regardless what asset class that you hold, subject to geopolitical whipsaw. Okay, and here's the fact: as we talked about non-farm payroll, that's kind of historical data, right? So it's really tough, and fixed income investors in particular that are coming from historically low volatility, right? And I would say somewhat of a complacent attitude heading into 2026. Now that we have this kind of volatility that we're seeing, they really need to sort of decipher between, okay, the economic data and geopolitical whipsaw. And you don't want to be whipsawed, right? So when we think about the fixed income as a whole, of course, when you have this kind of volatility in the short term, when you have interest rates move up, 40 basis points, not over a 3-month period, but over a 3-week period, everyone says, okay, risk off, right? And spreads widen out. That's just, it's the nature that we've always seen. But, with the spread widening part of it is not necessarily what was the headwind to total return in March. It was really the fact that interest rates moved higher.
Yeah.
And in fact, I would actually argue, given the fact of coming from some of the credit, headlines that we saw in February from AI, from software, from private credit, and going into immediately this kind of volatility, I would say actually credit spreads have actually done quite well. Yes, they widened out a little bit on the high yield side, and Anthony, as you know, we prefer higher quality. The investment grade corporate market had first quarter of about 650 billion in supply hit the market. There was just as much investor demand on the other side. The widening that we've seen is really not material because investors want to buy that yield.
Right. Because normally when you say credit spreads are widening, immediately you go to, investors are, looking out for all this risk that might be happening. They're looking at more options. So, but you're not saying that that's what this indicates this time, that the spreads aren't so wide that you're like, okay, now we're in a risk-on environment.
No, because you have to remember, we were coming from, again, what was that base? That base was historically tight spreads.
Right.
Right? So when you widen 30 basis points from historically tight spreads, you're still in the historically tight category.
That's right.
So all those spreads have widened. They have. Listen,
Yeah.
high yield's probably 30, 35 wider, which is really not that much given the volatility that we've seen. But of course, there's going to be dislocations. You have to absolutely pick your spots. And as you know, we still are number one, preferring that high quality because I can get much more compounding income and higher quality than. There's no need for us to go really that below, really deep down in credit right here because we don't know what's going to happen, how long it's going to last,
right.
Whether or not growth turns and slows because of household purchasing power declining, and that's really where we've been positioned in terms of that, just compounding that income for high quality.
Right, and it's not the first time we're dealing with credit spreads widening and rates spiking. We sat down in October of 2024 when the 10-year hit these multi-year highs on the yield, and so we're still way off of those levels. It was above 5%, I think, at that point, if I remember correctly. So I'm saying this is not a market that you haven't seen before.
That's absolutely right. I mean, I think what makes this different. I mean, October 2024. You're right. I'm glad that you brought that up because the Treasury index in March had its worst performance since October 2024. Right.
Got it.
So, and again, it's not just what the absolute yield level is, but it's that change, right? That really makes a difference in terms of headwind for fixed income.
But you like treasuries, right? You moved it to attractive in the last couple of weeks, and you still also like agency mortgage-backed securities, and even with 30-year mortgage rates now getting to around 6.5%, still off of the very high levels we saw last year, but a little bit higher than where they were. So talk about those positions.
Yeah, absolutely. Even coming into the beginning of the year, we sort of set this band that we felt the 10-year would stay between maybe 4 to say 4.5-ish, right, around those levels for a sustained period of time.
Right.
After we had this announcement or this conflict occur, and a couple of weeks went by, we kind of went to that 448 and kind of went right back down again in tens. But more importantly, the market was pricing out the cuts that they had put in February. As a result, we have a big rise in that short part of the yield curve. And our point was, and our positioning was, we do believe 2 cuts. We don't believe that the Fed is going to hike, which they are actually still pricing in, anytime in the near future. You know, our view on the Fed was it was delayed, not derailed. You'd still have these cuts. So as interest rates moved higher, we actually did move to a most preferred in treasuries in that 2 to 5 year area of the curve. Simply because we like that compounding income there. You're not going too far over your skis on interest rate risk. And that back end, you still have uncertainty, whether it's inflation, whether it's the deficit and bond vigilantes once again rearing the head, and just a lot of volatility that we just simply didn't want to take.
Right.
And part of the mortgage-backed security side is actually, you know, we've run a balanced portfolio within the fixed income side, meaning that we have high quality, but it's going to be the corporates and the securitized products. Agency MBS have done, you know, we ended February at a 598 30-year mortgage rate. We got up to about 640. Yes, MBS widened out. But in terms of overall positioning and definitely diversification, you know, they were one of the best performers in 2025. We think they're going to do well in 2026. I mean, as you know, affordability is a big issue.
Yeah.
We think they're a little bit too wide here. If you already own them, we'd actually increase the allocation. They're high quality, and you have 510, 520 in compounding income.
Excellent. Leslie, thank you very much.
Thank you.
Always a lot to get to when you come through the door, so thanks for joining us.
Appreciate it.
Good to see you. Leslie Falconio from the Chief Investment Office. And thank you all for being here as well. Make sure to check out more content coming out of the Chief Investment Office, including our very own Leslie Falconio at our Insights website, ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook. Plus, the studio, we have our own Instagram channel at UBS Trending. So give us a follow there. And as always, if you have any questions about what Leslie and I spoke about today, please make sure you're continuing this conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.